Well, thank you very much for organizing the conference, Susan, and for bringing us all together. I'm very pleased to see so many people are still here after such a long day with so many great papers. So thank you for that. This is a co-authored paper. My friend, Professor Krishnan, is at Case Western University in the finance department, and my friend Frank Partnoy is at the University of San Diego in the law school. I'm going to be talking about a specific form of shareholder activism, hedge fund activism, in a specific context, the United States. And so one important thing to keep in the back of your minds as you're thinking about, well, how does this all relate to what's going on here in India, is we're talking about very different ownership structures. So in the US, typically we're talking about dispersed ownership structures in our corporations, whereas here you have a much higher concentration of control shareholder run companies. And I'm going to give you a synthesis of a line of papers that I've done, ending up with the most recent paper, the one that's posted on the website. So I wanted to begin with a contrast which I think will be helpful, the difference between institutional investor shareholder activism and hedge fund shareholder activism. Institutional investors, as you all know, are public pension funds, private pension funds, mutual funds. And during the 1990s, when I first started in the academy, there were high hopes that institutional investor activism would be an aggressive and important form of controlling managerial agency costs. In fact, it turned out to be a relatively mild and, unfortunately, in some cases, maybe not in Margaret's eyes, but in others, weak form of monitoring. By the early 2000s, though, hedge fund activism started to catch on, and it exhibited a much more aggressive, much more tenacious, and much more productive form of shareholder activism. And one of the reasons is that hedge funds are fundamentally quite different from institutional investors. And I want to just highlight a few of the reasons why. First, they're very lightly regulated pools of investment capital. And that has significant implications. So if I'm a mutual fund and I want to engage in activism, I'm constrained by a variety of legal rules, such as the prudent investor rule, which requires me to maintain a diversified portfolio of companies in my investment portfolio. Hedge funds have no such requirement. And so it is quite common to see a single hedge fund have its entire asset portfolio invested in 5 or 6 companies at one time, not diversified in any way. Second, hedge fund managers are highly incentivized. If you look at mutual fund managers, they are paid on a basis of how much assets they manage, whereas if you look at hedge funds managers, they're paid not only on the basis of assets under management, but they also have a very, very substantial component of profits. So if they recognize a profit on an investment, they receive 20% of that profit before there's a distribution made to the investors in the hedge fund. So very highly incentivized to find good deals. And then third, there are relatively few conflicts of interests for most hedge fund managers. Unlike mutual funds, for example, they're not trying to sell their services to the companies that they're investing in, and therefore they're much freer in how they express their wishes to corporate management. So hedge fund activism has tended to be much more aggressive, and I want to contrast 2 important time periods. This will be sort of a theme as we go through the presentation. The initial time period was what we'll call the first wave of hedge fund activism from around 2000 to 2007, and then the second wave after the financial crisis, 2008 to 2014. In the first wave, hedge funds tended to target smaller companies. So small, under US public company standards, might be $500 million or less, whereas in the second wave, you saw more of this type of distribution. So if you, can you see, everyone see that?
It's a little blurred.
Focus? I don't think it's very in focus.
Yeah.
Anyway, this is market capitalization along the bottom here, and this is the percentage of companies targeted. And the dark bars are from 2014, the light bars are from 2013. And so what you see here is that the median investment size is around $1 billion. And that, in fact, a substantial number of companies with greater than $10 billion in market capitalization are being targeted. So there's been a big increase in the second wave of hedge fund activism in the size of the targets that are being taken on. Now, the typical hedge fund will buy a stake, usually between 5 and 10% of the targeted company when it makes its investment. And we know that because once they invest more than 5% in the targeted company, under US law, they have to make disclosure. They have to file something called a Schedule 13D, which provides quite a bit of information about the size of their investment, but also about their intentions, what they plan on doing with their investment in the company. Now, this next chart shows you one reason why investors really like hedge fund activism. There are two things going on here. Along the bottom here, we're seeing the time before the filing of the 13D. So this middle period here, this is the filing of the 13D. These are the days before, these are the days after. This line here shows you the cumulative abnormal returns to the stock during the time period that is running along the bottom of the scale. So there's a big stock price jump upon the public announcement of the hedge fund's investment in the targeted company. The other interesting fact is you see a lot of trading. This is abnormal trading volume. And remember, this is our public filing date right here. There's a lot of abnormal trading going on before the public filing date. Now, if you sort of net out the investments that the hedge fund is making, there's still a lot of unexplained abnormal trading volume. And it appears that that volume is generated largely by other hedge funds, what I'll call the wolf pack. The wolf pack comes in and follows the lead of the lead hedge fund and helps them to be able to exert substantial influence over the target company management. Now, as I said, hedge funds have different goals. Sometimes their goals are as simple as we want to communicate with management. Other times they get much more aggressive. Perhaps we want to have a dividend paid, a stock buyback, a recap, a split off of the company, or even a sale of the company. And to accomplish those goals, they engage in a variety of different tactics. So what I've set up here is a little diagram which shows you basically running from your left to your right, aggressiveness. So communicate with management, relatively passive. This is sort of the institutional investor strategy. But then you see seek board representation. Well, now obviously we're getting a little more aggressive. Moving along to threaten a proxy suit contest, bring a proxy contest, file litigation, even make a tender offer for the company. So as we move across that diagram, we're showing increasing levels of pressure on the targeted company to respond in a way which the hedge fund agrees with. Now, how important is this in the US situation? Well, one way to think about it is to think about hedge funds as an asset class and hedge fund activism as a subset of that asset class. And you can track how much they actually manage and how that changes over time. So in this first beginning period here, this is this first wave of the hedge fund activism. You see there's an increasing amount of assets going into the sector. Then along comes the financial crisis, a lot of withdrawals. Post-financial crisis, though, things start to really pick up. And in 2014, we're talking about $111 billion of assets under management in this one small sector of this one type of asset class. Now, $111 billion is a lot of money, but remember, they're targeting companies and taking a 5 to 10% stake in the companies. So you actually have to multiply that by 10 to 20 times to really get a handle on the amount of market capitalization that's being targeted. $1 to $2 trillion of public companies. That's a pretty big and important wave of activism. And not surprisingly, it's triggered a lot of discussion. There are two very polar opposite perspectives on whether or not hedge fund activism is beneficial from an economic point of view. Let's see, your left-hand side over here, you could think of this as the hedge fund's position. We're really targeting managerial agency costs. We're trying to force free cash flow to be paid out to shareholders, trying to focus the core business by getting rid of excess assets. We're trying to get rid of bad management, improve managerial incentives. All of those are consistent with the story that we're trying to minimize managerial agency costs. Now, if I'm a defender of the status quo, though, and I'm not so excited about hedge fund management, I focus on the short-run effect of a lot of these changes. And I argue essentially that target companies ought to be able to pursue long-term business strategies and not have to reduce R&D, cut down on future capital investment, and increase bankruptcy risk. So that conversation is quite polarized at the moment in the US. There's really very little common ground between those two sets of points of view. Now, this particular paper focuses, as I said earlier, on the second wave of hedge fund activism. The first paper that we published in the Journal of Finance in 2008 focused on the first wave. This paper focuses on the second wave, and there are some differences and a lot of similarities. So one important similarity is that we continue to find that there are high returns to hedge fund activism, at least during the time period up until 2014. Now, since then, there's been some reversals, and so we haven't actually collected that data yet. But as we saw in the financial crisis, asset flows into this category are quite sensitive to economic conditions. All right, in addition, in this particular study, we have just over 1,000 13D events, 578 funds, which shows you a much bigger number of funds, almost twice as many as were in the first wave. We continue to find targets are unprofitable. On average, we continue to find a substantial positive CAR to the reaction of the disclosure of the 13D filing, and we continue to find a substantial ownership percentage, in this case about 8.3%. How are we doing on time? 5 minutes, okay. All right, we compare three different measures of hedge fund success. And what we are trying to come up with is a way of saying this particular group of hedge funds is the most successful group of hedge funds compared to the rest of the hedge funds. So we look at, first of all, the most active group. These are a group that we construct based on the number of investments that they've made during the relevant time period. Then we look at a group called the top return category. They make a number of investments, but their investments tend to be highly profitable from shareholders' perspective. And then finally, we look at the category we call top investors. These are investors that have the largest investments in dollar terms in the targets that they actually go after. So here the idea is that they have a lot of what we would call skin in the game. All right, and each one of these categories has overlaps a little bit, but they're not very highly correlated. Now, let me just get to the main result. What we find is that the top investor category is the one that generates the highest returns relative to the remaining groups of hedge funds. They tend to be older, they tend to have more assets under management, they tend to have more portfolio companies, and they tend to have more board seats. And if you compare the market reaction to the filing of the 13D over a number of different relevant time periods, what you see is that they get a much bigger stock price reaction when they file a 13D than when a non-top investor hedge fund files a 13D. So the market is responding very positively to them, much more positively than it does to other types of hedge funds. And the question that we try to answer is, Well, why is that? Well, one answer is they seem to do better in terms of improving performance at the companies that they target. And this is not a long-term performance measure. We look at 1 year post-intervention performance. But you see increases in ROA, increases in sales, increase in R&D growth. You also see that the targets that they go after are more likely to be sold. So the more likely to be sold means more likely to get a high premium for investors. Investors like high premiums, therefore perhaps not surprising that they react positively when one of these top investors files a 13D. But there's more to the story than that. If you look at what they actually do when they invest in their companies, their target firms, they are much more aggressive. Now, I don't know if any of you know of Carl Icahn. Carl Icahn was a major corporate raider in the United States in the 1980s, transformed himself into a major hedge fund operator, very aggressive, always willing to get in a fight, and he rarely loses. So you see, if you look at this category of investors, you see they're 3 times more likely to launch proxy fights, 3 times more likely to win proxy fights, twice as likely to bring lawsuits, and 3 times more likely to get board seats when they make an investment. So they work harder, they're more aggressive, and they succeed more often, right? All the things that we think are good if we like hedge fund activism. But of course, if you think this is all about short-term profit maximization, and in the long run, this is stripping the companies of R&D investment and other things they need to be profitable, then maybe your interpretation of the results is not so positive. So just to wrap up, as we compare the first wave to the second wave of hedge fund activism, what we find is that activism is on the rise, still generating positive returns, still attracting a lot of capital, and that these top investors seem to be the ones that are most successful from the perspective of shareholders in increasing the value of the targets that they go after. Thank you very much.
Thanks.